let's take a look at problem 4-3 and see what has been given to us and what's been asked of us. So if you look at problem 4-3, we have Mayor Inc. that has reported income from continuing operations before taxes during 2017 of $790,000. They tell us additional transactions occurred in 2017, but not considered in the $790,000 are as follows. They've given us 6 pieces of information that were not included in the $790,000. Under instructions, they're asking us to prepare an income statement for the year 2017, starting from income from continuing operations before taxes. They've also asked us to compute earnings per share as it should be shown on the face of the income statement. Common shares outstanding for the year are 120,000 shares. They've asked us to assume a tax rate of 30% on all items unless indicated otherwise. Okay, so we're going to prepare an income statement, but obviously it's a partial income statement for the year ended December 31st, 2017. So we'll start with the first piece of information being the income from continuing operations before any corrections have been made. That was the $790,000. Let's read through the information and see which of this we do need to take into account and where we're going to make adjustments. So number one, they tell us the corporation experienced an uninsured flood loss in the amount of $90,000 during the year. So if it's an uninsured flood loss, we can assume that this is an uninsured flood loss. It's an unusual item. So this has to be listed under other expenses and losses. In number two, they tell us at the beginning of 2015, the corporation purchased a machine for $54,000. Salvage value is assumed to be $9,000 and has a useful life of $6,000. The bookkeeper used the straight line depreciation method for 2015, 16, and 17, but failed to deduct the salvage value in computing the depreciation base. So the formula should have been $54,000 minus $9,000 divided by 6 years. The bookkeeper has already done the calculations for 15, 16, and 17 without this $9,000. What was done in 15 and 16, those corrections will have to go by way of, will have to be an adjustment to retained earnings beginning balance. The 2017 error has to be corrected in the current year since we've obviously not finalized our books. So what do we do over here? I have the calculation here on the side. On the side, we have over here the adjustment for 2015 and 16 is made to retained earnings beginning balance. Depreciation expense should have been calculated as $54,000 minus $9,000 divided by 6. And I've written the formula up over here. And that should have been $7,500. What was done incorrectly? We forgot the $9,000 and did $54,000 divided by 6. So we depreciated in 2015, 16, and 17, $9,000 instead of $7,500. So did we under or overstate depreciation expense? We overstated. So the difference is that overstatement, that $1,500. Let's come back to the current year. Income from operations, because of this mistake of $1,500, is this number under or overstated? It's obviously understated because the expense was overstated. So let's make our correction over here. We'll say depreciation expense, adjustment for error, $1,500. And this gives us the operating income of $791,500. Now what I'm going to do after that is I'm going to see if I have any other revenues and gains and other expenses and losses. Now if you recall, we had already talked about that flood and we're going to put that number over here under other expenses and losses. Remember, these items should not be net of taxes. So it's that entire $90,000. Then they tell us in number 3, The sale of securities held as a part of its portfolio resulted in a loss of $57,000 pre-tax. It's just a regular loss. It's a part of doing business. You held securities, you lost money on the sale. So that will be listed over here. And it's the full 57,000. Again, it should not be net of taxes. It should be the pre-tax number. Number 4, when the president died, the corporation realized $150,000 in insurance policy. The cash surrender value of its policy had been carried on the books as an investment in the amount of $46,000. The gain is non-taxable. So this is something particular about insurance policies that companies carry on their key executives. They typically have these whole life policies that have a cash surrender value, which basically means if they cancel the policy, they would have gotten $46,000 back, which basically is the premium they were paying. They got $150,000 because the president died. So the $104,000 that they have, which is a gain, this number is not subject to any taxes. So let's put that number down over here. Gain on death of president. It's non-taxable. I'm writing that information for myself. $104,000. Now that I have all this information, I'm ready to calculate my income from continuing operations. I have this amount. Okay, let's continue looking over here. The corporation disposed of its recreational division at a loss of $115,000 before taxes. Assume that this transaction meets the criteria of discontinued operations. So this item would have to be listed under discontinued operations. Now, why did I leave the space over here? I left the space over here because I still have to calculate the income tax, and we'll do that in a minute. Discontinued operations. I lost money. So I have a loss on the sale of the recreational item. The loss was $115,000. I need that amount net of taxes. The tax rate I was told is 30%. So net of taxes is $115,000 times 70%, 1 minus the tax rate. That gives me a loss of $80,500. In number 6, we are told the corporation decided to change its method of inventory pricing from average cost to FIFO method. The effect of the change on the prior years is to increase 2015 income by 60, decrease 2016 income by 20 before taxes. The FIFO method, that's a new method we're going to use, has been used in 2017. The tax rate on these items was 40% in the last 2 years. Now, if we had not used that new method, we would have had to make an adjustment just like we did for the depreciation. But when you have a change in accounting method, the previous year's financial statements are recast to show what those numbers should have been. And in the current year, we've already used the new inventory method, so we have nothing to do in the income statement. Okay? So now we need to calculate our income tax expense to complete the income statement. Taxable income is $748,500. Our tax rate is 30%. Ordinarily, I would have said just take this number, calculate it, multiply it by 30%, and you get the income tax expense. But what do we have over here? This number is not subject to tax. So I will calculate the income tax expense as $748,500 minus $104,000 times 30%. That gives me $193,350. This is the income before tax, the subtotal. We've already seen what the loss on sale of recreation division is, leaving me with a net income of $474,650. Okay. Now we have to do the earnings per share calculation. Which numbers are we going to do the earnings per share calculation for? We will do it for income from continuing operations. We will do it for the discontinued item and for net income. In this problem, we don't have any preferred dividends. If we had preferred dividends, you will subtract it from the income from continuing operations and net income, but not this item. Okay? So we will do our calculations for income from continuing operations, discontinued operations, and net income. So our income from continuing operations is 555,150. There are no preferred dividends. So you just take that number and divide it by total shares outstanding, which is 120,000. And our answer is $4.63. Income from continuing operations, discontinued operations is loss. Again, divide that by 120,000 to arrive at the per share loss. And finally, the net income number divided by 120,000 will give you $3.96. So once again, key thing to remember over here is, if we had preferred dividends, you would subtract it from income from continuing operations as well as the net income number in order to calculate the per share, earnings per share, but you do not do it for discontinued operations.